Hey, welcome everyone to a very special edition of the Story Trading Weekly Meetup. We have made a ton of money in our community. AEHR just exploded, up 500% since it's been chosen as a VIP pick. So we got lots to discuss there. First, a quick disclaimer: Story Trading is not an investment advisor. Investing in securities involves significant risk of loss. This presentation is being recorded. Part or in whole may be posted on social media. So those who are not familiar, what's in a story trade? Story trading is understanding market pricing, aka the story behind the trade, through the lens of the four pillars of fundamentals, catalyst, sentiment, and technicals. We have an app coming out very, very soon, perhaps even this week. For people who are signed the NDA, we'll get a quick sneak peek at that. Our app is going to be the place to discover, collaborate, and validate market moving information through crowdsourced research and social collaboration. You can sign up to get onto that wait list at StoryTrading.com. So we're going to talk about VIP picks when we do have presentations at our weekly meetup. Any new ideas we track, we post them up on our website as VIP picks. That's where you're going to find AEHR Test Systems, which was chosen by Ashley Day in March, along with 49 other picks. As a whole, those 50 or so picks have dramatically outperformed the market. So I encourage everyone to go to StoryTrading.com and click on VIP picks to check out those names. So what happened with AEHR? Wow, look at this chart, man. This thing just exploded 5 times in 2 months. It's been an amazing ride. So what we're going to do is look at how that all transpired. So first, it started with Ashley Day presenting it as a VIP pick at $2.56 on March 14th. Since then, it's up 518%. You can find that video on our YouTube. After March 15th, I myself presented it on July 5th as a trade idea. Stock was at 270, and since July 5th, we're up 486%. And this is based on Friday's closing price of 15 in the 15s. Actually, in after hours, it closed at 1665. Very, very strong close. We'll talk about that in a minute. Then after that, on July 21st, inaugural presentation of myself and Story Trading over at Benzinga. What a great pick to start off our relationship with Benzinga. The stock was trading at 550. When I presented by after hours that afternoon, it hit $9. We had all sorts of stories published on it on newswires. We got on the map in an amazing way. The stock consolidated after that, but then continued to zoom up, as you all know. So there's a summary of everything we just talked about. 1582 close, 1665 after hours. I do want to note, Ashley officially closed his VIP pick Friday afternoon, up 499%. This doesn't say anything about his personal holdings. I have no idea where is that with his personal holdings. This is just simply for tracking purposes. He decided to close it out as a VIP pick. Now, that does not necessarily mean the run is over, and so we're going to talk a little bit about that. I have a couple charts here. A technical view I want to quickly look at. First, myself, I'll tell you, I was not planning on selling any. I was not tempted at all to sell before earnings, after earnings. It's Friday noon. I'm still not tempted to sell. But I was under a tremendous amount of pressure from people I really trust, including family, that were prompting me and then encouraging me to take some profits. I eventually did, starting around 3 p.m. on Friday. I ended up selling 25% of my position, and I sold calls on 25% of my position. So half my position is still owned straight out. Friday was the first time I sold any shares. Well, aside from a couple here or there for this little margin call on an IRA account, which was weird. It had to do with some calls expiring. Anyway, but it was substantially the first time I sold any shares on Friday. I held all the way from 270, and I didn't even buy on the way up. Maybe I should have, but I went all in to my max allocation. I was comfortable at $2.70, and I held it all the way through to close to $16. And I've never, ever done anything like that before. So that was a wild ride. So looking at the technicals, is it over? I personally don't think it's over. And a couple things I'm looking at. I'm looking at what's the behavior here. The last time we had a big gap up, you see it continued for a couple days after that. That was green, red, green, red. A couple differences, which I think make it maybe even more bullish this time, is that this big gap up was on a Monday morning after a Friday. So you had this good news that come out on Friday, people slept on it, and then Monday morning it went up. So when you have a strong close on a Friday and after hours, a close close to the high of the day, Monday morning is usually very good. And, you know, in the worst case scenario, I think the stock will peak sometime between 4 a.m. and 9:30 a.m. in the pre-market tomorrow, or I would even take it to 11:30 a.m. To me, that's the worst case scenario. I don't think we're going down tomorrow in the morning. So, you know, I personally think, I could be wrong, but I think the stock's going to be trading in the $17 to $20 range sometime between pre-market and 11:30 Monday morning. So looking at those candles and the volume over here, you can see this volume maybe has room to have a higher volume stick tomorrow. We'll see. Also looking at the RSI, the last time we had great news, the RSI was a touch higher. And RSI tends to act similar to stock charts. It has support and resistance levels. So I think, actually here, you can see my mouse now, you know, I think it may have a little bit room to get a little more overbought here tomorrow. Yep, there's the RSI right there we're looking at. So that's why I think that this can keep going. Now, looking at Rex. Rex looks at these all-time charts. He's looking at all-time high of $25. His very bullish. Actually, I don't think he's sold any yet, and that's interesting for a technical trader. And he's been in since under 3 as well. I sold him on it early. He likes the StoryTrading method. It's pretty cool when you get a technical trader who's interested in what we're doing here and our story trading stocks, and he really trusts the process. So he thinks fundamentals are important, and he kind of leans on us in terms of fundamentals, catalyst, and sentiment for good ideas. So he got in under 3, and he's held, I believe, the entire way. So he seems to be pretty confident at this point that we'll be testing the all-time high of $24 to $25. And what else did I want to show you here? There you go. There's an all-time high. And look at sentiment. Here's a comment on social media, which I think perfectly encompasses why I think the stock's going to gap up tomorrow. You have retail traders over the weekend after a very strong close on Friday. We don't have a risk of an offering. There's an active ATM going on. They're not going to hit that in pre-market. So it says AIR. So you've got a microchip and electronics testing company who's killing it during a microchip shortage, who has a deal with an EV microchip supplier, which is a Fortune 500 company, and they just nearly doubled the revenue forecast. And to top it off, their page shows a Tesla steering wheel. That's an important piece for retail traders, which needs microchips. And you're bearish on this. When their forward revenue is nearly doubled, what happens when 2 price targets come out to reflect their updated revenue forecast? I hope everyone makes money, but shorting this right now is a ridiculous play that would take up a lot of your day. Staring at a chart, it'll make a lot more sense to buy some shares and watch it unfold. I'm not advocating anyone buy this. I sold some Friday, right? But looking at combining that sentiment, which I think is probably a widespread sentiment, with these longer term and shorter term charts, I think if you're going to sell, the ballsy moves was to hold over the weekend and sell Monday morning, sell tomorrow, whether it's pre-market or sometime around 9:30, 11:30, or maybe Rex is going to be right, and 24 to 25. So that's my opinion on AIR. And with that, I'm going to invite Mark Gomes, special guest. You all know him really well. We're going to have a little bit of discussion, little kung fu over here on the Mark Gomes method versus the story trading method. All right. Interesting thing is, we'll have some good discussions now, Mark, but at the end of the day, it's funny that our actions are very similar. We just come at it from different perspectives. So we're gonna talk about that. So Mark, first, welcome aboard. How you feeling?
Feeling good. Good to be on the Ben Zinga show. Don't spit your copy out.
That's good. So how do you make out with AIR?
I mean, fantastic. We got in. I got in around 250 or so. Confidence built up enough to put that on my 1% portfolio. in the low threes, and it's still there, and then take that off. But we've got a risk reward methodology that I stick to. It's saved me from losses in the past and companies that I felt excited about. And it will keep me from gains as well. But what it does is it smooths out my returns over time, which, I like that nice, smooth 24 out of 26 years I've been up.
Absolutely. And that's the risk reward channel method. I have it up on the screen. If you're not familiar with it, I encourage you to go to Mark Gomes' YouTube channel. Where can they see those lessons and videos on risk reward method?
Yeah, I mean, the best place to start is if you just go to the front page of my blog site, Mark Gomes Stocks, there's 2 S's in the middle there, .wordpress.com. And the first article that comes up at the top of the page will take you everywhere else you need to go. Just keeps it simple.
Perfect. All right. So I think with your risk reward method, you were compelled to take some off the table. I understand last week, maybe even before earnings you did, right after earnings, but I'm not sure exactly where, but definitely before, where I was tempted to sell using the story trading method, kind of taking the sentiment and technicals more into consideration. So I guess you think your method is superior.
No, I don't necessarily think it's superior. I mean, obviously fundamentals, and I do agree with the 4 pillars. I think that is what drives stock prices overall. It's not just the fundamentals. Otherwise, if everybody operated purely on fundamentals, I wouldn't be able to make so much money. The fact of the matter is, if there wasn't such a thing as poor technicals and poor sentiment, then I wouldn't be able to find companies with great fundamental value at cheap prices, like Air was. When we looked at that, that's my criteria when I find stocks. Is I love companies where I find a $5 stock where my math says it should be 15, but the sentiment is low. People don't know the stock, don't believe in the stock, feel skepticism. Maybe there are things that you need to take a leap of faith, and I love connecting dots as opposed to having information dropped on my plate. So usually my picks are going to be something where people are asking questions and afraid to jump in because everything isn't just handed to them. But some of the biggest losses I've ever taken were in names where management handed me the whole platter, and well, if everybody's got the whole story on a silver platter, then the stock is probably fully valued, if not overvalued, right? But to your point, sentiment, technicals, and catalysts do play a part in where a stock goes, but it doesn't affect my domain, which is what it's actually worth from a mathematical, traditional DCF perspective. That's 2 different things, right? I mean, I like to find stocks that are selling for less than what they're worth. And what's great is if under the method that you espouse, stocks end up going to above what they're worth. And Air is certainly a candidate to do that. If you look at my risk reward chart on Air, I drew it traditionally, but said this is a special case where not only does the potential sentiment, the story, the connection to Tesla give it the potential to go a little bit meme and become overvalued. Stocks become undervalued, stocks become overvalued, but there is also the potential that there is more to this. If their IP is strong, if they get more of these customers, there's a lot of ifs that I don't feel quite comfortable with yet, but I know exist as potential, let's call it free call options that are affixed to the underlying stock valuation that can allow it to go much higher than where it is today.
Great. So this is where I want to challenge you a little bit. When you talk about the risk score channel and the DCF and what it should be worth, right? You're making some assumptions in there about peak revenue, right? Let's say $150 million, right? Isn't that just speculation? And how is that different than other market participants who are speculating that maybe their revenue is going to be hundreds and hundreds of millions of dollars because, hey, Tesla's validation, and now they're going to get Apple and the Apple Watch, and now they're going to get all the other EV makers. And isn't sentiment just a form of speculating on future fundamentals, which you're kind of doing anyway when you put a DCF model together, aren't you?
Yeah, and I would disagree with that 100%. And the reason for that is that 99% of all investors, including yours truly, before I was taught how to do this, have no idea how to calculate what the potential is, how to build an operating model, which is really the first step in understanding what a company should be worth. And that is why, if you wonder why since I've been in the public domain, this is actually my 12th year in the public domain, I come up with multiple triples per year on average. I've averaged over 2 triples per year. It's not a fluke, it's not luck. It's doing math on several companies, figuring out what their total available market is. Gaines provided great insight into how many machines are needed per number of vehicles being created, per data center, per this, per that. And you can assemble market research on how big these markets are, calculate what share of market they should get, how many units are going to be required, talk to the company about their margin and margin structure behind that, and build a set of operating models that say, under optimistic scenarios, this is what they could do. Under non-optimistic scenarios, this is how low they might go. Here is the most likely scenario, and here are the odds of each other scenario in between. So really all you're doing is creating, is calculating odds, right? As opposed to taking a gut feel approach to things. And I do have a gut feel approach to this. I still own the stock because I have a gut feel that there's a decent chance that this continues to go higher despite my fundamental risk reward range. It's an outlier from that perspective. I'd be strict usually on this, something getting to these levels, but there are still some unknowns that are explosive, more explosive than the typical company that I am involved with.
So yeah, you mentioned that call option of future potential business. Is that in your modeling, the upside of all that?
Well, I mean, it's something that you take into account. Like I don't do models like a Wall Street analyst does. A Wall Street analyst has to give you numbers. And so they have to pin the tail on the donkey and commit to a certain number. They have to take a guess. I don't take guesses. I have several scenarios. Okay. And so when I say the free call option, right, there's a set of scenarios that are within a normal range of what I think AEHR is likely to end up doing. Right. And this is this range right here. But then they can go above that, they can go below that. But in this case, it's one of those strange cases where if a number of things fall into place, that upside is much higher than is typical in a company that I find. And so even if there's only a 1 or 5% chance that they hit this is so significant that it actually does have a material impact and actually creates an additional layer on top of my risk reward range. And then in this case, my risk reward top was about 12, but that additional layer was closer to 15.
Oh,
okay.
That's it.
And we're there, but that doesn't mean you sell out necessarily, right? That's where you take profits off the table. And this is what I ask myself, right? If I owned no AEHR today, if I had 100% cash today, how would I allocate my money into companies like AEHR, Smith, TPCS, et cetera? That's one question I ask myself. The other question I ask myself is, which company do I like that has the best opportunity to double from here most quickly? So could we see AEHR go from 16 to 33? Or can we see SMSI go from 4.5 to 9? Or can we see TPCS go from $1.90 to $3.80? Which one could go up there most quickly? And when I ask myself that question, AEHR is currently number 3 on the list. And it's not 3 out of 3, it's 3 out of all my names. There's probably 20 names that I kind of like right now. There's my, starting 6. A lot of people know that I have 6 names that I really love.
So hold on. I'm a little confused because you said AEHR, if all that optionality happens for their business, the risk reward top side is 15, yet you're saying there's a chance it can double.
Okay. Clarification. The value of that optionality. Okay. So imagine if all those things come into play, the stock could go to 30 or 40, right? But if you bought a 1-year option on air with a strike price of 30 or 40, how much would you pay for that option?
Me? Nothing. I don't want that option.
It's, I mean, really, I mean, an air 2022 30 call. I mean, if it can go to, if it could go to 100, you wouldn't pay $3 for the potential for a 30 call option to go to 70.
Yeah. Well, you know, I that we'll see what happens. That may come back to haunt me. I don't know. Yeah, go ahead.
Let me just finish real quick.
Yeah.
So in that example where I say you wouldn't pay $3, well, that's exactly what I added to the top of my risk reward range. I added $3 as a top layer to represent the value of that potential.
I see. So, but if everything happens, the rosiest scenario for them in terms of business and industries they get into, where can this stock be in 2-3 years?
Yeah, I $40 is the number that I gave when I was in Europe about a month ago. $40 is the number that I would give you now, because I did a thorough assessment of the industry, and that assessment hasn't changed. Right? I knew then what they're going after. I know now what they're going after, and that hasn't changed one bit.
Okay, cool, great. So yeah, also clarification for me when I talk about, because I've had a lot of people, thank God, people made a lot of money on this. I showed my conviction. I was out there on social media. I was telling friends and family to buy this since 270, and a lot of people did well. And I started taking some profits or selling covered calls at the end of last week. And people like, Ben, why are you doing that? Didn't you say this could go to $50 to $100? And I'm like, yeah, in 2 to 3 years. And there's also a could in there. That's 2 to 3 years where I want to see business execution, where certain things have to happen. They have to win certain customers, like all that has to happen. So it's only been 2 months, right? So they're
right.
Yeah. So, that's why for me, I don't know if this thing hits Rex's numbers of 24 to 25, I may be completely all out. I don't know. And that's something I wanted to ask you earlier. Is there a number at which point that you're going to be like, I don't even want to hold for the possibility it goes to 40, like this week, right? If it happens today, is there a number that you're like, heck, this is crazy, I'm all out?
Yeah, I mean, that ends up being a little bit of gut feel, right? Because we've reached that kind of point of that risk reward top creates kind of an equilibrium point where, okay, if you hold for the long term, if you wait until the next time it hits the risk reward top, right? If I look at my chart right now, my risk reward lines are growing at an annualized rate of 20%, right? So under that, if everything remains stable, if all the ifs don't come into play and it goes cuckoo, right? The risk reward top would increase 20% between now and next year. That's not a bad return on investment. So if I wait from now until the next time it hits a risk reward high, I get a 20% return, and the story is still intact. So I think 20% is a reasonable return I can expect on this stock in the baseline scenario. But in the meantime, there's that potential that it actually goes cuckoo. That's something I want to own, right? My downside risk is, okay, it pulls back, but if it pulls back as a long-term investor, I just have to wait until it hits the top of the risk reward line again, whether it's